Hello and welcome to the first School Employer Advisory Committee meeting for 2018 here at CalPERS headquarters. To those of us joining via webcast, welcome to you all as well, and thank you for joining us. Also, a big thank you to CalSTRS who kicked off the meeting this morning, and it looks like they successfully kept you all awake and energized and eager to join us for the afternoon CalPERS session. I'm Jamie Pope. I'm the manager in the Stakeholder Outreach team within the Office of Stakeholder Relations, and I'll be the facilitator for the session. This is our first of 4 SEAC meetings that we're going to have this year here at CalPERS headquarters. If this is your first time joining us, we're certainly happy you're able to attend the meeting. And this is where you're going to be hearing the latest updates on services, programs, and policies related to your district's work with CalPERS. Just a few housekeeping notes, and then we'll get started with the agenda. Those of you who are here in person, you should have one of those gray CalPERS folder packets by now. They were kind of coming around as folks were being seated after lunch. Please make sure you only take one packet. We've put enough packets together for the number of folks that were registered here today. Remember the materials are available online. If for some reason you have trouble accessing those, we can make sure that we forward copies of those materials to you directly. As I mentioned earlier, we are being joined via webcast by many of your colleagues all across the state. So when it comes to the Q&A portion after each topic discussion, please be sure to wait for the microphone before asking your question. Otherwise, those joining us via the webcast will not be able to hear you, and that would be a shame for everybody, wouldn't it? I'm joined here by both Renee and Megan, who are sitting over there. They're going to be running the handheld microphones for that Q&A session, so be sure to wait for them to hand you that mic before you start talking. Now, for those of you on the webcast, if you have questions during any of the presentations today, we want to make sure we get those questions answered for you, so please email us at the SEAC mailbox. And if you're not sure what that mailbox is, it's CalPERS_SEAC@calpers.ca.gov. And we'll read your questions aloud to the group before answering. If for some reason your question isn't addressed here during the session in person, we'll be sure to circle back after the meeting and connect you with the right resources. Sometimes the questions that come in are very specific or they require a little bit more looking into, so we'll be sure to get those right resources in your direction. All right, so let's go ahead and begin with the agenda. And the first item on the agenda is an asset liability management update by, oh, look at that, it's me. So back in November's meeting, you may recall I shared with you that the board was going to be issuing a decision at the November board meeting regarding the portfolio selection, or what we referred to as candidate portfolios for CalPERS investments. So our board ended up adopting the candidate portfolio that was most similar to the current path with our investments and most likely to earn a 7% rate of return. Possibly the last portion of the asset and liability management cycle is really the amortization policy. And so I wanted to give you a little bit of an update about that today. The amortization policy was decided on and adopted just last week during our board meetings. It was in our Finance and Administration Committee. And when we're talking about amortization, you may think, well, that kind of sounds like a mortgage, right? And there's a lot of similarities there. So when it comes to amortization, what they were referring to is paying off the unfunded liability with employers over an extended period of time. Okay. Now, that sounds simple enough, right? Just like a mortgage. But we're CalPERS, and we're fairly complex. You may have noticed that by now. So what makes our amortization policy much more complex than other types of amortization that you may be familiar with, such as a mortgage type scenario, is that our policy, when it comes to pensions, we have to factor in gains and losses into that amortization equation. And that makes things a lot more complicated. So what about the amortization policy was necessitating change had to do with the normal cost versus the unfunded liability. When employers are assessed their CalPERS dues for the year, it's in two sections. And if you've ever viewed your valuation report, you'll notice that there's the normal cost, which is the normal cost for the year for the people to, those employees to earn their year of service credit for that year under that employer. The unfunded liability happens when the normal cost isn't enough to cover the entirety of the bill. Okay, and that can happen through changes in formula, salary increases, hiring increases. Any sort of those changes are going to end up impacting that unfunded liability. The reason that we needed to address the amortization policy had to do with an issue of negative amortization when it came to that unfunded liability. So if you can imagine making payments every month, let's say on your mortgage, but the payments you were making on that mortgage didn't even cover the interest, and so you weren't ever really making a dent in the balance that was due. And that's what was happening with some of our employers, is the payment was going toward the interest, but it wasn't even enough to pay it off. So it was really hard for our employers to gain any sort of financial ground with their payments because it seemed like they were never going to be able to pay down that balance. So here's what the new amortization policy looks like. The first bullet point that you see is a shorter amortization period. So we went from a 30-year amortization policy to a 20-year amortization policy. And that's going to help kind of level things out in the long term. You'll also notice where the second bullet point that says level dollar payments. That was a change as opposed to the previous way that we would provide the amounts due from employers, which was based on a percentage of payroll. So we got rid of just the straight percentage, and now we're giving them actual level dollar. There were changes both to something called the ramp up and ramp down. Anytime there was a big change in the actuarial assumptions or something of that sort, there were systems in place, such as the ramp up, that would kind of phase in those payments. But with the new amortization policy, we found that it's better to just streamline everything and keep everything fairly level going forward. It's also important to recognize that the policy is only prospectively applied. Okay, so the existing amortization bases are going to remain completely unchanged. And it's going to begin with required contributions for the fiscal year 2021 and 22. So you're not even really going to see these changes until the June 30th, 2019 valuations. The new policy helps protect the fund in a number of ways, primarily with benefit security. You know, we're taking that amortization and we're amortizing those gains and losses over a shorter period of time, thereby increasing the funded status. It improves intergenerational equity because by addressing these costs in the lifetime that they are incurred, we have the ability to not, we can avoid passing that debt that's incurred down from generation to generation to generation. And for contribution stability, while there may be a slight increase to payment variability, the payments that are going to be applied prospectively to that unfunded liability are going to be able to chip away at that balance that much more effectively. So this is going to ultimately save our employers money in the long run while helping increase the stability of the fund in general. So I got to tell you, I've had the occasion to spend a fair amount of time with some of our actuaries lately regarding the policy, and I've learned a ton, a lot. Some of those meetings left my brain hurting a little bit walking out of it, but I've had a chance to learn a ton. And I think the most valuable lesson that I've learned from our actuaries is that these individuals are capable of performing more complex mathematics in their head in a given workday than I really care to perform throughout the entirety of my lifetime. So I think it's important that we appreciate our actuaries. We thank our actuaries. If you see your actuaries at some point, whether you're here visiting or maybe an actuary comes to visit where you might be, shake their hand, thank them, give them a hug. Remember, they're doing the most exasperatingly complicated math out there so that you and I don't have to. And that's worth something. All right. So I think we are ready to move on with the agenda. And I'm not seeing him in the room for Scott for the legislative update. So we're going to go ahead and move to the next item in the agenda, and hopefully Scott will join us. Okay. Just wait for the mic.
I'm Veena from Orange County.
Hi, Veena.
And I'm even in a lower level than you are about understanding all this. But
we all are, Veena.
So in my mind, I'm curious only. When we have a 30-year mortgage, the example, you use the mortgage.
Right.
And we take a 15-year mortgage, our payment goes up.
Mm-hmm.
In the long term, it's a good thing. In short term, it's hard.
Right.
So is it going to work?
Is it going to work?
For employers, because with so many higher pay rates, and higher contributions, and then this will also increase, right?
Well, I'm not going
to
lie. There's no way to sugarcoat it. Are the payments going to go up a little bit over the next few years? Yes. They're going to go up very slightly. But here's what you got to remember. So, remember with a standard amortization policy, again, like a mortgage, like something we're kind of used to in our everyday lives, the only thing we're really amortizing is the interest and the balance, right? So by factoring in those gains and losses, primarily those gains, and amortizing those over a much shorter period of time, 20 years as opposed to 30 years, that gives CalPERS the ability to kind of realize the benefit of those gains to a much greater degree. So what that means is that it could actually potentially, and we have scenarios that were presented in the Finance and Administration Committee to the board last week, and you can take a look at those as well. Over the long term, you're actually going to see the payments drop lower than where they sit right now with the current projections.
So is it going to work for employers in their benefit?
In
short term,
sure,
not in long term.
Sure. So keep in mind, I'm not an actuary. Okay.
And
I just sat in meetings with many of them. Okay. But what we have learned from both our chief actuaries, Scott Tarando, and our deputy chief actuaries, and they're always keeping their finger on the pulse of best practices in the actuarial world. And what this policy does is it really kind of puts us in line with many other retirement systems where they say a 30-year amortization policy is just simply not feasible anymore, that it's much more prudent to have a 20-year and in some cases even a 15-year amortization policy. So this is what we had to do to not only put ourselves in line with what's considered to be industry standard for that policy, but also we had to make that move in order to ensure the sustainability of the fund. So that's why we did what we did. But in the long term, it's going to save the employers a lot of money.
Just like mortgage on the home.
Right.
So
Right.
it's just if we can make the payment and not go bankrupt.
Right. Right.
Thank you.
Okay, so we're going to go ahead and skip ahead. Scott must have been held up with something. So is Jennifer? All right, so next up, we're going to go ahead and skip again to Assembly Bill 1309 with the lovely Jennifer Rocco, who is going to be presenting a little sooner than she thought she was going to be. Thanks for being a good sport. Okay, so there's no clicker because I don't have a USB available, so you just use that.
Okay, so I'm staying right here.
You're staying
I'm not
right
moving.
there. You're not moving. You
All right.
You can if you want to, but
Then they can't hear me. Good afternoon, everyone. I'm Jennifer Rocco. I'm an Assistant Division Chief in the Employer Account Management Division. I'm here today to talk about Assembly Bill 1309. So really quickly, we'll do a quick review of the definition of a retired annuitant. We'll talk about the bill, what the employer requirements are under this new legislation, and some resources. So first, just a quick recap. A CalPERS retired annuitant is someone who has, number one, retired from CalPERS, and number two is returning to employment with a CalPERS covered employer. So just a quick recap there. So there's two requirements that a retiree needs to meet prior to employment. One is a bona fide separation. The other is that they have to serve a wait period. The bona fide separation is something that's required by the Internal Revenue Service. It's federal law. It's required so that we can maintain our tax qualified status. There are some exceptions to the bona fide separation, but generally speaking, if they retire younger than their normal retirement age, so that means if they have 2 at 55 formula and they retire at 53, if they're younger than that normal retirement age, they have to meet this requirement. So it's 60 days that they have to wait between their retirement date and the first day that they come back to work with the employer. And to add to that, they can't have any agreement in place or be negotiating any type of an agreement to return to work. There has to be a true separation. The wait period is a little bit different. This is actually in the government code where any retiree has to wait 180 days between their retirement date and the first day that they come back to work. There's also exceptions for this. For example, we recently had all the fires that happened, and one exception is if there's a state of emergency. So in that case, this was waived, and there were retirees that were coming back to work sooner than 180 days. Also, there's no exception if that retiree receives some type of a retirement incentive. So even if it's a state of emergency, they can't come back to work within, they have to wait that 180 days. So let's talk a little bit about the bill. So Assembly Bill 1309 was effective January 1st, 2018. It amends the government code. It's section 21220. For those of you who have the Pearl up here, basically what it says is if employers fail to either enroll retired annuitants within 30 days of the effective date of hire, or if they fail to report the pay rate and number of hours worked, that CalPERS will assess fees in those cases. So what are the fees? So if an employer fails to enroll a retired annuitant, meaning you don't key their appointment into the system, there is a $200 fee per retiree per month that they are not enrolled in my CalPERS. For the pay rate and the number of hours worked, if that's not reported, again, a $200 fee per retiree per month until their hours and pay rate are reported in the system. So there's two pieces. One is tied to the enrollment. The other is tied to the reporting of their pay rate and their hours. So reminders, again, retired annuitants have to be enrolled and have their hours reported. This is an issue we run into quite a bit. By doing this, that gives us a few things. So first, we're able to validate through the system that the wait periods are met. If they're not enrolled and reported, we have no idea whether those wait periods are met. Also, we send out courtesy letters when they reach the 700-hour and the 800-hour mark to make sure they don't go over the 960-hour limit. So if these individuals aren't enrolled and their hours aren't being reported, we can't do that. So we need all of our employers to be able to be going in and logging or enrolling these people. The other issue that this helps with is when you have retirees who could potentially be working for more than one employer. Maybe they don't let you know that, but if both employers are enrolling and reporting that member, we have the information to know where they are with their hours. So it's super important that that information is reported to us. And then just a note on the bottom, for the fiscal year, it's July 1 through June 30th, so that's where that 960 hours limit falls. All right, so some resources for you. There's some circular letters up on the screen. There will be a circular letter coming out outlining just what I covered related to the legislative change. There'll be another circular letter coming out in July. The reason being is right now there's really what we're calling a grace period for these fees. We're currently working on implementing all the system functionality necessary to track the enrollments and assess fees as needed. So as those details are worked out, there'll be a follow-up circular letter to let you all know how they'll be assessed and billed and those details. And we anticipate that happening probably around the June timeframe. A public agency and school reference guide is also up here. It's a great tool to use. There's information in there about retired annuitant appointments. And then our publication 33 also has some great information in it. If you have questions, you could call the Customer Contact Center, visit the website, look at the Pearl, and then we've also included two important email addresses here. So membership reporting at calpers.ca.gov. If you have any questions regarding whether a retiree is an independent contractor or an employee, you could send your questions there. And there's also the Working After Retirement mailbox. So if you have any questions about the hour limit, the wait period, the pay rate for a retiree, you could send that for those questions to the Working After Retirement box. All right, so I think that covers just about everything I had, so I can step back and take questions.
Vina, if you could just hold on for just 1 second. We've got a question that came in through the SEAC email box, and it says, can an employer have a salary schedule for a class of one? Is there anything that prohibits this? We've caught wind that during a CalPERS audit at one of our districts, they were told they were out of compliance because CalPERS does not allow a class of one.
Megan, could you give the mic to Brad Hansen? Thank you.
My question has nothing to do with what Jennifer just spoke about, but yes, that's correct. You cannot have a group or class of one. In situations where we identify that someone is receiving benefits and they're the only person in a group, oftentimes what we'll do is we'll deny whatever compensation they have and we'll tie them to the most closely related group or class. But that actually is in the Pearl in 20636.1.
Thank you, Brad.
Thank you, Brad and Jennifer. That was a question that popped up. It seemed like they really wanted the answer, so. slightly off topic.
were a couple
That's
other
okay.
questions.
All right, Vina, pardon me. I'm sorry I interrupted
No,
you.
that's okay. Thank you. Veena from Orange County. About this $200 fee per member per month for payroll reporting line. Let's say we hired a retiree on February 27th, and it was too late to pay in February, so the next month they will pay it in March, which is our next cycle. But month of March, we report on April 10th, in that payment to your office, but it's dated March only. There is nothing, there will be a separate for February line for 27, 28.
Right.
So that means we will be penalized.
I'm not on the payroll reporting piece, Brad. Do we know how that would work if it's payment for February in March, but it's not actually sent to us until April?
Because it's
I don't think that they would be assessed the fee.
It really
but-
just depends on when your file posts. As long as when you post the file and that information's in there, you're going to be okay.
Yeah.
Let's say you posted your earned period report, though, and you reported it a few months after the time it was due, and those retired annuitants weren't in there, we would go back and assess the fee then.
So then the February 2 days will be reported in the earned period of March, which is sent to your office at, let's say, around April.
April 30th.
So I
Right.
just want to make sure. this
Without the
timeline-
earned period, we don't know who's reported, right? So once the earned period posts, that's when we'll get the data, and that's when the system will be triggered to do that look to make sure you reported that person in their hours.
Yeah, so but it will have a February line and it will have a March line.
Uh-huh.
So are we going to be penalized $200?
I don't believe so, as
I
long
don't
as you
believe
put
so
them in the
either.
proper line.
Yeah.
Okay, even though you received it in April.
Correct. As long as it's reported with the proper month, you should be okay.
Oh, okay.
Yes.
So
We're
it
still
can be 6
building it.
months also, or
Right, that's
just-
what I was just going to say. We're still building all that in the system. We're at the point where we have our requirements, so we don't actually have it designed in the system yet. So that's why I said there'll be another letter coming out closer to July with those minor details in it.
In every case, we'll take a look at it, and if something was done in error, we could potentially have waivers for errors, just like we do with our missing and late payroll.
Yeah,
Yeah.
it won't be an error because we process payroll only once a month.
Right.
So it will be on a following month, but then we are 1 month behind.
As long as it's associated to the right month,
Yeah.
though.
Okay.
Once you report that person return a new and it shows the proper month, you should not get a fee.
Okay.
Yes.
So I have to write to you.
Yes.
I'm just
Write to Jennifer.
Well, yeah. I
No,
was
okay,
gonna
write to
say,
me, write to
it's
me.
both of us, actually. That's why he keeps standing up.
I have 2 other things
Sure.
to clarify. Under the bona fide separation, on your slide it says exception may apply. And I always thought there was no exception to this.
The only exception that we're aware of is the emergency. So if
Okay,
there's a
that's the
declared
only-
state of emergency, that's really the only one that would
100.
apply for this. The 180-day break, there are a few other exceptions. Yeah,
okay.
but that one is the only one we're aware of.
Okay, the last one I have is on the wait period.
Mm-hmm.
And I think I heard you saying there is no exception, but I thought we can do a resolution.
So no, there are exceptions. So where there isn't an exception is if that retiree received some retirement incentive. So they have to serve the 180-day break.
Oh, yeah, those.
So
yeah.
your board can sign a resolution to bring someone back sooner.
Incentive.
Absolutely, yes.
Thank you.
You're welcome. There.
Hi, Lena from San Bernardino County.
Hi.
I have a question. So potentially an employer could be assessed both the $200 for not enrolling him and the $200 for not
Correct.
for not reporting the hours and the rate. But can you define what the employer is to CalPERS? And is this going to be assessed just like the mandatory arrears invoices, where it's coming to the county office and not necessarily the actual employer?
So I think it's going to be the same as the arrears process.
We
Right.
consider the county
Yeah,
office the
the
contract
employer,
holder,
yeah.
so all the fees will go to the contract holder.
Yeah.
Right, and
Which is a COE.
we have a little bit of issue with that only because, and I'm sure everybody, we're not technically the employer. We don't hire. We don't have any, and so this just poses like another issue that we have with our arrears, where they're saying the county office, because they're being told by your office, the county office is the employer, that we should be paying the administrative fee. So I'm afraid that this is exactly what's going to happen too. They're going to say, well, the county office didn't report it. And you're the employer, and we've gotten written correspondence from CalPERS saying the county office is the employer. And so now it's created a weird relationship with us and the district that was involved for this particular thing, because we're not hiring them. We're
Right.
just getting the information from and you guys are requiring us to report for them. We're not the actual employer.
Right. I don't know if there's any way
that's
around that.
We don't contract with the districts directly. We
Exactly,
do
yeah.
with the agencies. All the contributions also funnel through the county office as well.
Right, but that's because you're requiring us to do it, not because we're saying we don't want them to do it. You're not allowing them to, which puts the but I mean, I'm sure everybody else would agree. We're not the employers. We don't hire them. We don't know where else they're working. We don't know their hire dates. We're just
Right.
getting the information from them.
Yeah, all the districts, though, the only reason why they're with CalPERS is because they're under your county office. You guys are basically like the parent agency that allows these districts to have CalPERS benefits. So we see it as the county office is the contract holder responsible for upholding the laws as well as the financial liabilities.
Yeah, but I guess.
I get where you're coming from.
Right,
Don't get me
yeah.
wrong. Yeah.
Right. And then when you're actually specifically saying, the county office is the employer, then
Right.
does that mean when we collect money from districts, we don't have like an excess cash fund. We collect and we submit to you. So there's not additional money. So, this $400 or the $500 administrative fee, we don't have that on hand to pay for the district, because we're saying we're not the employer.
Do you bill the districts when they're the ones that create the issue?
We do, but then when they get correspondence from your office saying that they're not responsible in the county offices because they're the employer, then that's where we're running into
Maybe we
issues.
should work on the language of our letters.
Yeah, I think we need to go back and work on our letters.
Right, because I don't know about anybody else,
update
but
some
this
of
just
the-
recently happened, and I have the email from CalPERS saying the COE is the one that has to pay, and so we are
I mean, from
constantly-
our eyes, because the receivable is under the county office,
Right.
that's how we see it, that you're on the hook to pay the contributions.
Right, but if you're saying we're the parent, then
Yeah.
we're not technically the employer. We're not hiring.
Yeah.
But yeah, maybe
Right.
Contract
even if you could
holder.
just,
Right.
right, even if you could just go back and look and explain, and because like I said, now we've created issues with guidance given to our district saying that we're the employer, and now they want us to pay the admin fees.
Right. We could probably work on the wording on the letter if that's creating conflict.
Yeah, absolutely.
I just wanted to add.
Let's get a mic for Vina.
Are you going to answer that?
I don't know.
Just sit right here. My new co-presenter, Brad Hansen.
Come on down, Brad. Get comfortable.
I just wanted to add to what Lena was saying, that how you did there is a bill for replacement benefit payment where a county office can go and draw the funds from the district. Maybe it should have something like that, clarified that even though you are charging, but there should be a bill to say we can go and pay you guys. Because otherwise we are always haggling.
with the district.
You're talking about a legislative change.
Yes,
Okay.
legislative change. Like we did, there is one in place for replacement benefit.
Yeah,
I'm vaguely familiar with that. I
yeah.
don't know enough
I
about
don't
it,
think so.
though.
It's in place, but it's in the process.
Okay.
We'll look
So
into
it
that.
should need something like that.
Yeah, we can look at that, and also Brad and I can work together on some of our letters to.
Because
switch
we
up
are
the
otherwise
language.
working with your collection people.
Right.
All these fees and invoices, on top of it EFT, we have just become accounts payable, receivable for person. Thank you.
Yep.
Hi, this is Lori from Los Rios Community College District.
Hi.
And under your slide where the Assembly Bill 1309, the last point there, it says report the pay rate and number of hours worked of a retired member employed in any capacity. at a CalPERS agency. Would this apply to CalPERS retirees working in certificated work?
No, because that wouldn't be a CalPERS covered position, right?
Correct,
That's a
correct.
CalSTRS covered
Yes,
position.
but it says at a CalPERS agency, so I just want to make clarification on that.
Yeah, it should say in a CalPERS covered position, because those hours wouldn't count towards hour 960. So
Perfect.
we can make that tweak.
Thank you.
We've got time for one more question. So Ramona, you'll be the last one, and then we've got one that just came in to the website.
Sure.
I'm just going to tack on to that. It wouldn't matter if the individual retired under an ES 372 election. So they retired out as a teacher under CalPERS.
No, CalSTRS has different laws or different rules around their retired annuitants that they might be subject to. I know Heather's standing up, so I'm going to let her chime in too.
So I think what you're thinking of is back when we would hold a member to an ES 372 for that employer. So if they returned to work for that same employer after retiring, they were kind of held to that old 372. Ever since we came back out with every position is a new position to that, as soon as they retire from that position, if they came back to another certificated employment after retirement, they don't have any rights to have that covered by PERS anymore. They're not held to any previous election anymore, unless it was somehow that same position with, that same employer.
Which it shouldn't be if they're a retiree. All right, and one more.
Yes, this one comes from Kings County Office of Education. It says, will my CalPERS ever have a mass lookup to allow employers to upload a file to look up CalPERS membership status in order to avoid fees, arrears, etc.?
Not at this time. It would be a system enhancement that we'd have to look into for a future date. All right. Thank you, everyone. I'll stick around and hang out at the break, so if anyone's questions didn't get asked, happy to answer them. Thank you.
All right. Thank you, Jennifer, and thank you, Brad. We're going to backtrack just a little bit. I saw Mr. Blackledge come into the room a few minutes ago, so we'll go ahead and pick up here with our legislative update from Scott.
Hi, good afternoon. Okay, I'll just go over a few things. I think last time we met, we talked about all of the bills that were signed into law and vetoed. Of the bills that remained in the legislature that were introduced last year, there were several that failed to make a deadline in the legislature to pass out of their House of Origin by the end of January, and so those bills actually died. And if something like them were to move forward, they would have had to have been reintroduced this year. But, none of these were, though. So these were bills primarily relating to our investments. AB 946 that required CalPERS and CalSTRS to divest from any companies that are involved in building President Trump's border wall. That bill died, and that was Assembly Bill 946 by Ting. Assembly Bill 1310 by Assembly Member Travis Allen. That would have required a retirement system governing board to disclose the unfunded liability and healthcare debt of the retirement system on each member's statement. That bill failed, and so it's dead for the year. Another bill by Assembly Member Allen, AB 1311, would have added a couple of appointees to the 13-member CalPERS Board of Administration. That died. There was a few others. Senate Bill 32 by Senator Morlock that would have created a Pension Reform Act of 2018, which would have suspended cost of living adjustments and generally reduced benefits for members that died. Senate Bill 560 by Senator Allen would have had CalPERS and CalSTRS assess financial climate risk of all of its investments. That bill died as well, along with Senate Bill 571 by Senator Pan, which would have allowed but not required a public employer participating in deferred contribution employee retirement plans to automatically enroll employees in such plans. So that would have been 401k, 457 plans, and the like. So that was the final action on all of those bills introduced last year. And now we can get into bills that were introduced this year. The filing deadline, or the bill introduction deadline, was this past Friday, and that's passed. And there were several bills related to CalPERS that were introduced. I'm only going to go over a handful of them that actually relate to school employers or the CalPERS board. I'm not talking about the ones that are having to do with contracting agencies. The first bill is a CalPERS sponsored bill, AB 2196 by Assembly Member Cooper. And the board agreed to sponsor this legislation, which would require a member that elects to purchase or convert service credit on or after January 1, 2019 to pay any remaining balance. This won't be on your list. Sorry. The bills I went through before, that was on your list, but these new bills have been introduced in the last week or so you're not going to find that on the report. But you can look them up in the legislature's website and find out. So AB 2196 has to do with member service credit purchases, and it would prohibit members on or after January 1, 2019 from making installment payments into retirement for their service credit purchases. So right now, we allow members up to 15 years to repay their service credit purchases, and we also allow them to do that into retirement. So for any elections that happen on or after January 1st, those would be, if a member retires before they finish making their full installment payments, then what happens is this, and it gets a little complicated, but instead of being able to continue the installment payments, our CalPERS actuaries would look at the balance due and make a calculation of, they would do an actuarially reduced equivalent of the unpaid balance, and they would amortize that over the lifetime of the member. And so let's say that somebody made a service credit purchase 5 years before they retired. They elected 15 years repayment option. For the 10 years that remains, that would be the amortization period for the way it currently stands under existing law. What this bill does is for the unpaid balance, it amortizes that over 30 years and it deducts it from the member's allowance, the benefit that they otherwise would have received. And so the member would still benefit from the employer contribution, especially for service prior to membership or for redeposits. But generally, the difference in the member's benefit is going to be the difference between whatever remaining amortization period they would have had under their repayment schedule and what their actual lifetime was. So anyway, any questions related to that? I think this may affect your classified members. I know a lot of them may wait. I mean, they don't get paid a whole lot in many instances, and so they wait to make these service credit purchases as they near retirement, and so this will impact them. In a lot of instances, the difference in the benefit between the current practice and the future practice is going to be a handful of dollars, and they won't have to have that payment amount deducted from their check anymore. So anyway, let's go to the next. There's another bill that CalPERS has sponsored that would allow the board to set the compensation of its chief operating officer and chief health director. That's AB 2415. Okay, and then these are bills introduced by other legislators. AB 2571 by Assemblymember Gonzalez-Fletcher. That would restrict CalPERS alternative investments, such as private equity, venture capital, what have you. It would restrict us from investing in those vehicles if the investment vehicle is managed by an investment manager who is not adopted and committed to complying with race and gender pay equity policies consistent with the bill's requirements. And it would require CalPERS to also disclose this pay inequity information at least once annually to the state auditor. Another bill, Senate Bill 984 by Senator Skinner. Among other things, it would require the composition of state boards and commissions, and so that would include CalPERS, to be at a minimum of 50% women. It also requires the Secretary of State to post this information on its website. Senate Bill 1031 by Senator Morlock. That would suspend or prohibit any public retirement system from paying a cost of living adjustment to retirees, survivors, and beneficiaries in any calendar year that follows a fiscal year in which this system identifies an unfunded actuarial liability of greater than 20% in its annual report. And then we've got three more bills. Senate Bill 1033 by Senator Morlock. This is a bill introduced by Senator Morlock to require the state, schools, and contracting agency employers of CalPERS, any employer that increases the composition of a member who was previously employed by a different CalPERS employer to bear the actuarial liability for that action when it increases the actuarial liability beyond what would have been reasonably expected for the member. It doesn't define what reasonably expected means, but CalPERS was required to do this for specified management employees of contracting agencies in the 2013 pension reform, and we created a definition. This may be somewhat different, but it would apply to all employees and all contracting, in all employees, whether representative or managerial, and it would also apply to state, schools, and contracting agencies. These liability transfers just happen on the books. But in the case of the school employer pool, I think it would be rather difficult to do. I don't necessarily expect this to pass, but without it being amended, so we'll keep you updated on that. And then there are a couple of bills by Senator Mendoza that we're tracking for you, and that's Senate Bill 1062, which would require a CalPERS contracting agency whose payment of employer contributions for member benefits is delinquent to notify members by mail within 30 days of its delinquent payment. And it requires a CalSTRS employer whose payment of employer contributions for member benefits is delinquent to notify their members within 30 days. And then one last bill. This only applies to state employees, but it's Senate Bill 1149 by Senator Glazer. And it would allow most state employees optional membership. It would provide them the option to participate in a defined contribution plan instead of a defined benefit plan. And that would be operated by CalHR. It does provide a one-time option for the member to go back into a defined benefit plan, but they have to pay any difference in the cost of the benefits for doing so. So with that, I'm happy to answer any questions, any other issues. I think we'll have more as time wears on. There were a number of what we call spot bills that were also introduced this year, and that relate to CalPERS benefits, and so we expect in the next month or two to see the additional language amended into those bills so they may impact you going forward. Okay. Thank you for your time.
All right, moving forward with the agenda. Next up, we have the topic of the ever so complex reciprocity with Mr. Brad Hansen.
I miss the days when I used Yep, I'm just kidding. So good afternoon. For those who don't know me, my name is Brad Hansen. I am the Assistant Chief over the Contributions Compliance section at CalPERS, which oversees payroll and comp review, and our audit findings. We also call them employer reviews. And today I want to talk to you guys about reciprocity. And you might be thinking, well, we have CalPERS contracts, so we don't really have reciprocal. Why do we want to hear about this? Well, we're going to probably rely on you guys to get us some of the information we need to do the reviews for members that have reciprocal agreements with CalPERS. So, which one's, oh, here we go. Okay. So let me give you guys a brief overview of a reciprocal determination process. You guys all know what reciprocity is? You know, other retirement systems can contract for a reciprocal agreement with CalPERS. There is these 37 ACT employers that all have reciprocity. There's also some outliers that have it as well. CalSTRS has a reciprocal type agreement with CalPERS. It's not quite reciprocity, but for the sake of today's discussion, they basically have reciprocity with it. The same rules apply. In order to have those benefits of reciprocity, you must retire from a CalPERS agency and the CalSTRS agency or another reciprocal agency on the same day. If you retire on the same day, you get both vesting rights as well as final compensation exchange. In most cases, if you're retiring from a CalPERS agency, we're going to use our data to calculate your final comp. Most likely, when you're retiring from your latest agency, that's going to be your highest salary, right? However, if you're retiring from a reciprocal agency, we then send a form to the reciprocal agency and ask them for supporting documentation to back up the compensation that we're going to use in the calculation. So we send out a circular letter on February 1st, and you can see it's up here on the big screen, on February 1st, 2018. And it's actually available on the web, by the way, just checked. A lot of our circulators are down right now because we had an accessibility issue, but this one is up there. And it kind of informed all of our agencies that as of March 1st, we're going to require breakdowns of final compensation for all of our reciprocal members. This reciprocal form requires that you identify the membership and the retirement date, the type of retirement and the years of service, confirm if there's a disability app on file, and then the position titles, which I know is one of the least favorite things to provide, but it's only once at the time of retirement. We also ask for the member's final comp, and then if there's special compensation, we require a breakdown of the components, and we would also like the pay schedule and labor policy or agreement. So why are we doing this? So in years past, we kind of would just blindly accept whatever the pay rates were or the special comp that an employer wanted to use. We had certain thresholds that we would apply to, but in reality, we didn't really look at it as closely as we should. So we determined that we need to apply our same government codes and regs to the final compensation from a reciprocal agency as we did to our own members. So what that basically means is if you can't provide us a breakdown or the supporting documentations, we may not use the final comp from that reciprocal agency. We would just use what CalPERS has on file because we can confirm all of that information. So for instance, if an employer says that they're giving someone $5,000 special comp and they're not letting us know what it is, we'll deny that. We need to see that, yes, indeed, it's something that meets our regulations, something that we would allow. Things like phone allowances, car allowances, things like that. Those are some common things that we see. Those aren't reportable with CalPERS. They have to meet all of the different special comps listed in our Regulation 571. So we are applying this rule, but it's not going to be officially applied until March 1st of this year, so within a week. So what we're just asking of you, the schools, is that if you get any of these reciprocal breakdown forms, and I have a copy of it right here, please provide us the supporting documentation, because CalSTRS is saying, because we did a survey of all our reciprocal system, CalSTRS is telling us that they don't have the MOUs, the publicly available pay schedules, or can provide breakdowns. So we'll be reaching out to the schools to see if you guys can provide that for us. If you can't provide it for us, then we may reduce the person's allowance and there will be a delay on their retirement. Does that make sense? Okay. And again, we'll work with you too. If you can't provide it on the form, we're going to create a mailbox where you can send that documentation is. And the good news is once we get it once, we might not need to reach out to you again because we'll try to maintain it. Of course, if we got it in 2018 and we're doing a retirement in 2025, we haven't got a new one, we'll need an updated version. But as the more of these that we collect, the less of the burden will be on you because we'll be able to back into your MOUs and publicly available pay schedules. The most important part, though, and one of the more difficult things is providing that breakdown of the special comp. Sometimes employers will give us payroll and we can't make heads or tails of what it is. If you can provide us a breakdown, which is actually on this form here, looks like this. It kind of reminds me of the 1344 they do for arrears, not to open up old wounds. But if you can provide us a breakdown like this should suffice, and we can get that person on roll with what they're entitled to. So in short, we're just kind of tightening our rules. We want to make sure that we don't create any more unfunded liabilities and that members are truly getting paid things that are PERSable, so to speak. And these are all the different government codes and regs that back up the reason why we're now applying this to all of our reciprocal final comps. I think you guys all got copies of this presentation. Okay. All right, is there any questions? Yes, Vina.
Wait for the mic.
Oh.
There you go.
First question, it's not a question, it's a suggestion. First one. When we do that reciprocity form, and we send it to PERS or STRS, whichever agency, I wish it's a requirement to attach a copy of the other agency where they were a member or something, some kind of certification that they're coming from STRS. This is their termination date or something like that. Just a suggestion, because lots of time we take things, whatever person puts down on the form, and then later on it involves misunderstandings and corrections. It would be nice that we are required to attach
what they had from that agency.
Like a certified, something.
That's a good suggestion.
And
so, Vina, sorry, hi, I'm going to address that one because it's a little bit different than this. You're speaking about the reciprocal self-certification form to determine PEPRA.
No, not the PEPRA one, the reciprocity for when we say the person has a reciprocity.
At the time of enrollment, correct?
At the time of enrollment.
So, yeah. So at the time of enrollment, when you do the reciprocal self-certification form with the member, it isn't your responsibility to validate the information. It's the member's responsibility.
Yes.
And we do understand that members do make mistakes on those. And we have heard some of that feedback as well about having them have to somehow prove to you, the employer, but we don't want to put you, the employer, in that situation to have to validate.
I mean, we are not validating, we just pushing it to you guys. I'm just saying.
Well, we don't take those
on,
forms, though. Those
yeah.
forms stay at the employer level. All you need to do is enter what's on that form into the system. If that member does come along later and try to establish reciprocity, we do go back and review that. And if there is a change, we will make those adjustments. We'll reach out to you guys to have the member fill out the form correctly, make those adjustments. And we are working on making that form stronger out to the member to say that you need to validate this information that you are self-certifying so that you have less of those instances where
where corrections are needed or misunderstandings and all.
Mm-hmm.
Okay, I'm just suggesting.
But I appreciate that feedback because we are revamping that form right now.
Yeah.
So
okay, second one, when you were talking about how you have that form that you were showing where we provide the information. PERS has 12-month final comp.
Yep.
STIRS most of the time, depending on years of service, has 36 or 12. So we give you 36 or 12 months of leave?
It probably would be best to give us the 36-month final comp just in case
we
the
don't
highest.
want to if we are not required.
Okay. Well, we only require the 12-month final comp,
Okay,
so
that's
12
what
months
I
should
wanted.
suffice. If you gave us more, though, that could help because, as you guys know, with CalPERS at least, we don't always use your last 12 months. We can use the highest 12 consecutive months at any time in your career.
Okay.
But I would hope that the reciprocal system would provide us that anyhow. But yes, we only require, if it's 12 months, which school all is 12 months, the 12 month. Unless they're PEPRA, right? Then it's 36.
Yes,
But we probably don't
right.
have many PEPRA members as of right now that will be retiring.
Okay,
Yep.
that's all. Thank you.
Yep.
Is the request going to be made from the school district or from the county office? And how would it be made, like mail or?
If we got this form back and we didn't have the break, so this will go out to the members' reciprocal system. They would probably send it back to us without the breakdowns. We would then, in turn, the compensation review area would reach out to the district to get this information. Of course, if they don't have it, we'd reach out to the county office. We would use any resource we could to try to get this information.
And since this is a new requirement, how often do you expect this to happen for schools?
Every time that we have a retirement that has a reciprocal, with a member who has reciprocity. If they're trying to retire concurrently from both us and CalSTRS or a reciprocal agency, we require that breakdown. Good question. How much time do I have? Okay. We have another question.
We're going to receive this form for all, not just if they were reciprocal with CalPERS or CalSTRS?
For anybody that has reciprocity. So if you have a member that happens to have reciprocity
with the city of
with whatever, and they're retiring from the school. I mean, more than likely, though, in those cases, we wouldn't need the school, right? They're not retiring from. So these, majority of these are going to be the person's retiring from another reciprocal agency. So they're retiring from a city's retirement system. More than likely, they're not working for a school. So you're not going to see many of those, I'd imagine.
Okay.
Does that make sense?
Right, because I was going to say, we don't have those.
No. No, so if they're retiring from CalPERS, you probably will never hear from us.
Okay.
The only time we would is if the reciprocity period was higher from the time that they worked for the other reciprocal agency. We wouldn't reach out to you anyways. We'd reach out to the other employer.
Okay.
Right. Yeah. Since I have a few extra minutes, I've been getting quite a few questions about AB 1487. Would you guys like to hear anything about that? Okay. All right. We are creating a circular letter for that. It should be going out sometime next month. The number one question I've been receiving from everybody is, when is the effective date of it? And it actually is effective January 1st of this year, 2018. The approach we're taking is a self-certification. So initially, once we send the circular letter out, we're going to attach the form. We're going to leave it up to the employers or the schools to certify if they had anybody that was working in an upgraded capacity for more than 960 hours. So if you had anybody that worked in upgraded capacity, even if they didn't exceed the 960, you still fill the form out and turn it to us. And then that's it. We don't do any additional research. We don't ask for any additional required documentation. However, if you do exceed the 960, then we will assess an admin fee of $200 and additionally charge you 3 times the amount of the difference between the contributions all the way back to when the upgraded position occurred. It's not specifically tied to temporary upgrade pay either. It could just be that you're paying them and not reporting the temporary upgrade pay. That's one of the common misconceptions with that. Eventually, we're building the system out so that it will be a self-certification on my CalPERS, which will make it a lot easier. So one of the issues that schools will have is we require it for all the districts as well. So each district will have to fill this form out. Even if they had nobody, they just fill it out and say they have nobody and send it back to us.
So all you need is the form.
Correct. We're not going to ask for any additional documentation if there was a recruitment, if you had a vacancy. Initially, we're going to send you this self-certification form. It will reiterate what the law states, 20630, I believe it is. And we'll put it on to you, the employer, to have to self-certify that. Just to warn you, though, if there's any kind of ethics complaints that are associated to this, or there's any audit findings, we will make you go retroactively, report the proper amounts to us, and bill you for the fees or the penalties. So it'd be in your best interest to report it correctly. We have a question in the back.
Wait, just hold on a second. The microphone's coming your way. We're going to ask you to repeat the question anyway, so the folks on the webcast can hear. Thank you.
So the question would be, this is beginning as of January 1st, anybody we have working out of class.
Correct.
We report each district will be responsible for reporting all the people that they have doing that, whether they are at the 960 or below.
Correct.
Or above.
Correct. Or if they have nobody, they just need to certify they have nobody. So that means that this period's only for 6 months. Any of the retroactivity, if you had people working out of class from July 1st, 2017 to December 31st, 2017, that time will not apply. We're just starting fresh January 1st, 2018.
And that'll be part of a circular that you send out to.
Correct. It should be coming out in the next few weeks. There were some issues that we were trying to work through on it, and that's why there's been a delay. But I foresee it going out in the next few weeks.
Thank you.
Yes. All right. All right. Well, you guys have a CalPerfect day, and I'll talk to you later.
You heard it right here, ladies and gentlemen. CalPerfect Day. I've been here 10 years. That is the first time I have ever heard that phrase uttered. We'll be sure to coin that phrase for sure. All right. Thank you very much, Brad. Moving on to the agenda. Next up is PEPRA membership with Alicia Watts from the Office of Audit Services. Looks like you've got a little.
Do I need to advance it?
Yeah, I don't know what's going on here, but it's just the. There we go.
Okay.
Yeah, just use the arrow.
Okay. Hello, good afternoon. I'm Alicia Watts. I'm a manager in the Office of Audit Services, and I'm going to talk a little bit about kind of what Heather touched on already, which was a cycle of audits that we did pertaining to PEPRA enrollment and PEPRA membership. We basically looked at agencies that had enrolled employees after January 1st of 2013, and we looked to see whether the members were correctly enrolled. Now, I'd like to note that this final report has not been made public yet. We are in the final stages of finishing it and anticipate that it will be posted to CalPERS website in the next couple of weeks. And all the agencies that we review during this cycle of audits will receive a copy as well. So, I'm going to talk a little bit in high level here. Okay, and I have some Heather and her team who are the subject matter experts. If you guys have any specific questions I can't answer. Let me go here. Okay, so today I'm going to talk about our objective with this cycle of reviews. PEPRA, what PEPRA defines as a new member, the laws and regulations that we audited to during this cycle of reviews, how we went about selecting our sample, the procedures and the specific scope of our review, which was a very narrow focus, some preliminary results, and the importance of enrolling employees correctly. Now, our audit objective, as I mentioned before, was to determine whether employees hired on or after January 2013 were enrolled into membership correctly, pursuant to the California Public Employees Pension Reform Act of 2013. And as you all know, PEPRA provides for reduced benefit formulas and a higher retirement age for new members. And this is what the law defines a new member. A new member is first established, is one who first established CalPERS membership prior to January 1 of 2013, and who is rehired by a different CalPERS employer after more than a 6-month break in service. So if those criteria are met, then they would be brought in as a new member. Also, a new member is somebody that's brought into membership for the first time on or after that date. And then also the third area would be a new member that's brought into membership after January 1, who was a member of another public retirement system, but not subject to reciprocity. And Heather kind of touched on that a little bit. All other members would be considered classic members. And this is just the government code that defines reciprocity. Basically is the recognition by CalPERS of certain reciprocal rights available to members who move from one public retirement system to another. So if they don't have that reciprocity, as I mentioned in the slide before, then they would be considered a new member under PEPRA. And these are some of the government codes that were the criteria for our audits. The government codes on the top set forth the criteria to, as I talked about, the new members under PEPRA. And then the CCRs further define some of the areas such as new members, reciprocity, what a break in service means. So these are what we use as criteria when we go out and perform our reviews of the employers. Now, our sample selection, we selected a total of 62 agencies to review for this audit cycle. Out of those 62, 38 were public agencies, 18 were schools, and 6 were state agencies. And some of the areas we looked at specifically 2 areas when we went out and did our audits. Our scope is very narrow. We keep it very focused. And for each agency that we went out and we reviewed, it's a sample of employees. So we're not looking at everybody. We're looking at a sample of employees that were enrolled after that January 1st date. For the first area, we're looking at whether agencies retain that self-certification form that Heather mentioned before. It doesn't have to be that form. CalPERS puts out that form, but they have to, the government code requires that they have some sort of a written self-certification from employees. So these forms and self-certifications are the basis for establishing eligibility for certain benefits for those members who may move from one public retirement system to another, as I mentioned before with reciprocity. We also look to ensure that the agencies are retaining those forms because that is a requirement as well. So they should not be sent to CalPERS. You guys should retain them. The second area that we looked at when doing these audits is whether new members were whether members were enrolled correctly. So in some cases, we did find instances where members were not enrolled at the correct enrollment level. And here's our preliminary results, and I say preliminary because we have not issued that final report yet. Over 50% of the agencies that we reviewed did not retain the self-certifications. And as part of our field work, we did ask if we were out at an audit site and our auditors didn't have the forms, or the agencies didn't have the forms, we did ask that they obtain the forms if possible. And in most cases, that was, they did. So, but 50% of the agencies did not retain the forms, and over 25% of the agencies enrolled members at the incorrect enrollment level, classic versus PEPRA. And I just want to point out one thing. At the past educational forum, which I recognize a lot of you, so I'm sure a lot of you were there, we had somebody come up to us and tell us that, this was a really great audit, oftentimes we're looked at as, oh, it's the auditors, but that they didn't know about the form. They didn't know that they needed to retain these. It was an educational experience where the auditors sat down with them, helped them understand the government codes and the laws. So that was really nice to hear, just that we provided some value, that, we were out to kind of help educate and make sure you guys are, adhering to those requirements. So that's just something I wanted to mention, since we don't hear that too often. So. And then just the importance of enrolling correctly, why we determined this to be kind of a high-risk area for CalPERS, which is why we decided to do this cycle of audit reviews. There can be a lot of errors that result from an employee being incorrectly enrolled into the system, miscalculation of employer and employee contributions. So, if we determined that somebody was incorrectly enrolled as a classic member when they should have been PEPRA, that's going to be a lot of adjustments that have to go back. Delays in processing member retirement benefits. Also, inaccurate retirement estimates. So when an employee or member goes to get a retirement estimate from CalPERS, if they're not at the correct enrollment, if the system has identified them at the wrong level, then that's going to affect their estimate that the system is going to generate. Also, an incorrect payment of benefits and a reduction to retirement benefits for members. So if we do find in those cases where we found these members that appear to be incorrectly enrolled, program area will work with the employers to ensure that those employees are enrolled correctly. And obviously, in some cases, that's going to result in a reduction in benefits. So that's why we feel it's really important that we were out there and educating employers and helping to ensure that everybody is enrolled correctly. And then lastly, there's a circular letter that CalPERS issued in October of 2017. This informs employers of the revisions made to the self-certification form. And I know Heather mentioned that they're in the process of revamping that form. So we're kind of constantly looking for ways to make that form more beneficial for you guys and to help you, enter that information correctly into the system to avoid any errors. And then the circular letter also provides employees with more information on the importance of providing this accurate information. So something that I believe it's on the CalPERS website. I think I found it there. So it should be available if you want a little bit more information on the form and just the importance of reporting correctly. And that's all I have. Does anybody have any questions? No? Okay. Thank you.
All right. Thank you, Alicia. We have a little bit of extra time, and I'd like to take advantage of that time by inviting our subject matter experts to stick around for our panel discussion. So, the Brad Hansons of the world, Heather, Jennifer, don't go far. I think I could go ahead and kick it off here. We had a couple of questions that were emailed into the SEAC email box, and I'm just going to go ahead and read the questions, and whoever wants to grab the microphone first and provide an answer is greatly appreciated, and then we can go ahead and go around the room, and if you had any questions that weren't necessarily covered in the presentations today, or any burning question that you wrote down 3 weeks ago saying the next time I'm at that SEAC meeting I'm going to ask them this question, this is going to be the time to do that. So let's go ahead and start here. Okay, and this it's a bit of a long one. So it says, I didn't see the topic on the agenda today. I had a question regarding circular letter 200-007-18. I'm sure you guys have all that committed to memory. Dated January 16th, 2018. This circular letter explained the instructions for how employees who were employed by a school employer on or before December 31st of 2017 that meets the definition of creditable service under CalSTRS, but were enrolled in CalPERS, to either retain membership in CalPERS or to have past and future service reported to CalSTRS. Okay, now after all that, my question is, when the employee completes the retirement system election for misreported service form, and we submit it to CalPERS on or before the deadline of June 30th of 2018, do we need to wait for approval from CalPERS prior to making any necessary adjustments to the member's CalPERS account and reporting the service to CalSTRS? And that was from the Fresno County Office of Education.
That's me. Okay, so it has to do with SB 525 and the new misreported service under Government Code 20309.7, which is the new government code for it. And the election would be if the member was misreported in PERS and they know that and don't want to continue to be reported in PERS for that employment. They want to go back to STRS. Yes, I would say that we would like to get the election. We would like to review it before any adjustments are made. We will be in contact with the employer based off of our review to make sure that that is a valid election, because we have received 2 or 3 and came to find out after speaking with a member that that's not what they were wanting to do. So I would say yes, please hold off on making any adjustments to the member's account until you hear from us.
All right, thank you, Heather. I've got one more here, and this is related to AB 1487. So it says, regarding the self-certification form where the employer has to state everyone who is in an upgraded position. This limitation applies only to employees working out of class in a vacant position during recruitment for a permanent employee to fill the position. It does not apply to employees working out of class to fill in for an employee who is on a temporary leave. Will your self-certification only require the district to state those working out of class in a vacant position during recruitment for a permanent employee to fill the position? And that's from Ventura County Office of Ed.
So that's a really good question. The circular letter will speak more on that. That's all I'll say.
Okay, well, that's a CalPERific answer there, Brad. All right, that's all I have from the SEAC inbox. Burning questions. Wait for a handheld microphone and they'll be brought to you.
Sean from LA County. Brad, question for you. What often happens for these out-of-class appointments is you may have somebody who's out on a leave, somebody may fill in for their position, and it can sometimes cause a chain reaction of somebody then filling in for them, someone then filling in for them. Will the circular letter address that as well?
It will, and I can address that part. It really should just be for the position that's vacant. So for instance, let's say that, that I left CalPERS and Heather came in and was temporarily upgraded to my position. And then behind her, Jennifer took Heather's position. Because Heather is not gone and her position is not truly vacant, then Jennifer wouldn't need to be reported. However, Heather would be because my position's vacant. And that's the part that we're still looking into, is the definition of vacancy. And that's why I said the circular letter will address that. Does that make sense? Does that answer your question?
Yes.
Okay, thanks.
Thank you.
Yeah.
I have a different question. We talked a little bit about the change in amortization policy and what the effect of that on the employer contributions, which led Vina to ask, are districts going to be okay with this? And I think really what she's alluding to is the continued pressure on employers to meet the obligations for these payments. My question is, I know in government code there are provisions that allow for public agencies to do cost sharing of employer contributions with the employees. I don't know if that applies to schools, though, and I was just curious about that. I only saw it there specifically
Yeah.
for public agencies.
Yeah, you could still, a school is considered a public agency in our eyes, and you can contract for cost sharing benefits. It used to be that it had to be tied to an upgrade of your benefit, but that's no longer the case with PEPRA. You can just cost share for any reason now. Of course, it has to be approved by your board, and we need all the supporting documents and whatnot, but yes, cost sharing is still available to schools as well.
And that would even be in the schools pool? Because everybody's kind of on that same contract, right?
Yeah, that part I'm not 100% sure on.
But for any school employers that are on their own contract, they could potentially modify their contract for cost-sharing provisions where the employee pays more of the employer share.
Yeah, I don't know if there's any schools, though, that are not part of that school pool.
Our office, LA County, is on its own contract, yeah.
Maybe we should have the contracts unit probably follow up on that one. But from what I understand, that, yeah, schools can do cost-sharing agreements.
Yeah, we're going to go ahead and do a little bit of research and talk to the subject matter experts in that area, and we'll circle back with an answer for you.
Since I have the mic, I have one more question, and then I've been holding out.
All right, but that's all. No, I'm just kidding.
We have, in LA County, we have a lot of charter schools popping up all the time. We have JPAs that come up. The approval process to become a CalPERS agency is very long for us. I don't know if that's typical. It can take a year or two for an agency to become approved by CalPERS. To be a CalPERS agency. Is there anything we can do to speed up that process?
Just really quickly, that's just the nature of the process as far as all the times it has to go before a board for approval. We can get more information from the contracts team, but only because I used to oversee it. I can tell you the best thing to do is make sure you have all the information required up front. You have things calendared with your board ahead of time. That's really the only tidbits I can share, but we can circle back with the contracts team and get some more details for you.
Thank you.
Okay, any other questions? Oh.
I had a couple of questions. The first one's for Brad. Has to do with retro payments. So if I have a district who is settling in, say, November for the prior year.
Mm-hmm. When you say settling, what do you mean by that?
So they've come to an agreement. They're getting an increase for the prior fiscal year.
Okay, gotcha. Okay.
So you have the one retro for the prior year, which by default, you'll have a retro for the current year just because it's bringing it up to what last year's was. But it's not a retro for this year.
Okay.
It's a retro because last year's rate increased. Then they settle for a one-time off salary schedule for this year. They're not getting an increase to the salary schedule for the current year, just the prior year. For the current year, they're getting a one-time off the salary schedule.
Okay.
When it's reported to CalPERS, is that going to cause an issue since it's going to look like they're getting an increase for the current year and an off salary schedule payment in the same year?
Yeah, because it's got to be in lieu of a salary increase.
But it is in lieu because they're receiving a retro for prior fiscal year.
Okay, so I'm trying to follow. So the retro you reported this year, but it's really for the prior year.
Right.
And now they get the off salary schedule pay for the current year, where there's no additional pay increases.
Well, because my step 5 was $13 last year.
Okay.
It's now increased to $14.
Okay.
For the current year, all of those are still they need to go up for last year also,
Right.
but it's not a retro for the current year.
It's just catching it up because
just
you had
catching
to-
it up because last year.
It's one of those things when we first review it, we might look at it and call you, but if you
Okay.
could explain that, it should be fine. As long as the pay increase
We'd
was
have an
truly for
MOU
the
for that,
prior
yeah.
year. Right. So you basically, because it took so long to get the retro in there, you had to also increase the next
current
year just to catch up on it, but really it was applied the prior year. I totally understand, and that should not be a problem. But just knowing that when we review payroll, it's not
It's
always
gonna look
abundantly
like.
clear. We would probably just call you, and you could, if you verified that, you'd probably be good to go. Just my every situation is a little bit different though, but based on that high level example, I'd say that would be okay.
Okay. My second question is, I've heard lately that when you separate someone in my CalPERS, that the sick leave balance that you are entering in is supposed to be just what they've earned at your district.
I don't know anything about sick leave reporting, unfortunately.
Somebody, I hope, does. Oh. So we've not ever done that. It's been their balance. That's what gets entered into that sick leave balance. But I've heard from 2 other counties recently that they're being told that they need to reverse that and put in just their county's sick leave, not the transferred. It's transferred to that county, so that's what we've always put in. But this is just recent. Within the last month, I've heard from 2 counties now. Here, I'm gonna pass this to Vina because she's one of them.
PERS just started the sick leave audit only few months ago. So we never knew that till just now. But like I said, auditors are saying it's by employer means that county office, because like Tim always says, you are the data owner, you are the employer. So, and but their sick leave unit of PERS is saying carry business as normal. Like we always understood that the sick leave available on unused sick leave available as of that point. Okay, so we are just getting 2 different, information.
Just really quickly, so that would be best answered by our benefit services area. I know that there was just an audit and there are some questions being ironed out as a result, so we would have to work with Anthony Sweeney and his team to get you the final answer.
Yeah, thanks, Jennifer. We will circle back with the benefits team and get a direct answer, and we'll probably just email that information out to the entire mailing list for SEAC, so thank you.
Okay, so I have a couple questions back to the misreported service. So the circular indicates that if the employee wants to remain in PERS, that there's nothing then that has to happen. So my question is, 10 years down the road when they do go to retire from PERS and they're filling out their retirement app, and in that process, they write down that they're, some title that is a trigger to PERS that maybe that's not really one that should have been in PERS. Is there going to be something in the record to show that this law, this person was a member prior to December 1, 17, so they are okay? Because there's not going to be anything on file anywhere.
Yes, so first, just to address the first part of that, if a member basically elects to stay misreported in PERS by way of not filling out the election, there's no action needed from them. However, if we do find that some of their employment that's connected to that position that they're reported in PERS, some of it's also been reported at STRS, we're going to ask the employer to get it all in one system, meaning you need to make sure that it's all under PERS. Because what we've seen is in the past, someone's been misreported in us, and then in 2012, they get the message, oh, it's an adjunct faculty. We never should have reported him there. Start reporting him to STRS. And so now you have the same position reported in 2 different systems. So that is like a secondary piece of this where we're going to be looking at those, and if the member's feeling like I still have some of this stuff over at STRS, we will be asking for those adjustments to be made. So there may be some action from the employer. From the member, no. If they want to stay, they stay, and that's that. We're only going to find out if they have it misreported or some of that service reported somewhere else if the member brings it to our attention or the employer does, and that's the action that we'll request them to make. down the road they go to retire and they write their position, nobody's going to question that position at that time. The positions come into question when they're enrolled, and that needs to be something that, this is one of the biggest pieces going forward after January 1st, is getting the employer to certify the information that's now like on, the 372 form, saying that this is the type of employment it is, so we cannot allow people to get misreported. That's why we created all those questions that are now associated there. This covers anyone before that. So if it comes into question later and we know that they entered that their enrollment date was prior to 1/1/18, they're fine. They can stay. If we see that they're after 1/1/18, we're going to request adjustments being made.
Okay. And then my other question would be, if you had someone that did elect to have the service, submitted the form, come out of PERS, go into STRS, what is PERS' expectation with regards to their Social Security and what they had paid in? Does PERS have any guidance or suggestion?
You'll have to work with Social Security on that. We cannot get involved in that piece of it. So if a member has 10 years reported here and they elect to have that 10 years go to STRS where it originally was supposed to go, how the Social Security will be handled will all have to be worked out with the employer and Social Security. I know there's limitations sometimes of how much they'll pay out, and that's something that member needs to be aware of before they make that election.
Okay, I just didn't know if PERS would have any guidance, being that they're the state Social Security administrator.
If you have questions, you can contact the Social Security Administration, but I don't know.
I could just chime in and say that the employee is only going to get the statute of limitations. They're only going to be refunded the 3 years, 3 months, and 3 days, I believe it is. Anything beyond that, they are not entitled to a refund from Social Security. That's really the general information that the administrator can share.
Okay.
Yeah.
Thank you.
You're welcome.
I've got a couple more that were emailed into the SEAC inbox here. And this one comes from Roseville Joint Union High School District. And they're asking, can you touch on the new member criteria again? I've been told before that once you have enrolled in a miscellaneous 2% at 55 in the public school system, you will always be a classic member, even if you have a break longer than 6 months or start with a different CalPERS agency.
So that's true when it comes going from school to school. So much like the state, all state employers are seen as one employer. All school employers are seen as one employer, including the 2 PAs that we have. They are seen as school employers when it comes to the new member criteria being looked at. So if you are a school member and you have a break of more than 6 months and you're going to Citrus Heights, the city of Citrus Heights, who contracts with CalPERS, you're going to be a new member with that agency if you have a break more than 6 months. But if you're going from San Bernardino County Schools to Santa Cruz County Schools, and it takes you a year to get that second employment, you're fine because you're going from school to school.
Great. Thank you. And then one more question, semi-related to that. This one comes from Santa Clara County Office of Education. If an employee was a CalPERS member before January 1st of 2013, so a classic member, then withdrew all the money from CalPERS, then later became a CalPERS member again in 2018, should this employee be classic or PEPRA?
That all depends on the employer that they refunded from. If they're coming back to the same employer, then we could look at that previous refunded membership date, but if they're coming back to a different employer, it's not going to make a difference there.
Excellent, thank you. Any other questions here in the room? Of course.
As far as that cost sharing question goes, I think I may have misspoke. You possibly could do it through MOU, but I don't believe you could do it through a contract amendment with CalPERS. But we should have either actuaries or the contracts area follow up on that. So sorry if I misspoke on that.
You're forgiven, Brad. Again, yeah, we're going to follow up and get the correct answer and probably even extra information on top of that for you. Great. Any other questions for the panel? Going once, going twice. All right. Well, just a reminder that all 4 SEAC meetings will be held here at CalPERS headquarters, right here in this room, Lincoln Plaza North, room 1140. The dates for the next meetings are going to be Wednesday, May 2nd, Wednesday, August 8th, and Thursday, November 1st. The format of the meetings will be exactly as it was today, with CalPERS in the morning, or CalSTRS in the morning, and CalPERS in the afternoon. Lastly, our next board meeting will be held Monday, March 19th through Wednesday, March 21st, right here in the CalPERS auditorium. Thank you again, everyone, for those who've taken the time to join us out of their busy schedules, whether here in person or joining us via webcast. Safe travels for those traveling back home, and we look forward to seeing you in May. Thank you.